Welcome to today's Explainer. We are diving headfirst into a massive legislative move that could literally redefine the global financial system as we know it. We're unpacking the proposed U.S. Digital Asset Market Clarity Act, or simply the Clarity Act. This is a monumental effort to regulate a market that has just exploded completely outside the traditional financial system. We're looking at a scenario where mind-boggling amounts of wealth are floating in a regulatory gray area, and lawmakers are scrambling to box it in before the next elections. To really understand what's at stake here, we're going to break this down step by step. We'll start with the trillion-dollar market, then enter the Clarity Act, look at the political tug-of-war, explore commodities versus securities, and wrap up with the market impact and future.
Part 1. The trillion-dollar market.
Before we talk about the laws themselves, you really have to understand why the U.S. government feels such a burning need to step in right now. By March 15, 2026, the global cryptocurrency market capitalization hit an astonishing $3 trillion. That's trillion with a T, according to official disclosures submitted to the SEC. To put that into perspective, that is larger than the entire GDP of many developed nations and exists almost entirely outside of traditional, centralized banking regulations.
The explosive momentum here is just wild. Despite experiencing the kind of severe price volatility that gives traditional bankers absolute heartburn, the market saw a 500% growth over the last 5 years. It's a market defined by massive swings, sure, but the overall trajectory has been this undeniably steep upward climb that regulators simply cannot ignore anymore.
And if you zoom in on specific sectors within that broader market, the numbers are just as crazy. In the past year alone, the market value for stablecoins surged by 50%. This rapid expansion in assets, designed to basically act like traditional cash, is throwing up some major red flags for traditional banks.
Now check out this data straight from the Federal Reserve. It turns out 10% of U.S. adults are using crypto right now, but here's the catch. Almost all of them treat it strictly as an investment. We're talking 9% buying and holding to make a profit, while only a tiny 2% actually use it to make everyday financial transactions. People are treating it like a digital stock market, not an actual currency.
Part 2. Enter the Clarity Act.
So the big issue is that this massive, multi-trillion-dollar investment space has operated with huge regulatory ambiguity. Pushed by Senate Majority Leader John Thune, the Digital Asset Market Clarity Act aims to finally create the very first comprehensive federal framework in the U.S. The goal? Regulate crypto trading platforms, set the rules for brokers, and significantly tighten up investor protections. If passed, it officially ends years of confusion over who is actually supervising the sector.
But the clock is ticking loudly on this. After disagreements caused the Senate to delay the vote over the summer, lawmakers are now staring down a critical procedural vote in mid-September. They need a 60-vote threshold just to open the floor for a final vote, and looming over this whole shebang is the immense pressure of the November midterm elections.
Part 3. The political tug-of-war.
Getting this legislation passed is proving to be a fierce battle. You have pro-crypto groups and Republicans who have poured over $119 million into supporting industry-friendly candidates for 2024. They want clear, Congress-led rules. On the flip side, you have traditional U.S. banks and Democrats pushing back hard. They are demanding stricter money laundering oversight and are terrified of how stablecoins might compete with traditional bank deposits. It's a massive clash of interests.
And complicating things even further are the massive financial ties of prominent political figures. For example, reports indicated that the Trump family made over $1.4 billion from crypto-related projects during 2025. Democrats are pointing to figures exactly like this to argue for much tighter ethics rules regarding government officials' involvement in digital assets, which is obviously adding a lot of friction to these negotiations.
Part 4. Commodities versus securities.
Setting all the politics aside for a second, at the very heart of this puzzle is a deeply complex legal question. How do we actually classify a digital token? The Clarity Act attempts to neatly divide regulatory power once and for all. It proposes giving digital assets classified as securities to the SEC while handing commodities over to the CFTC.
But legislating that division is so much easier said than done. Expert Sharif Osman points out that these boundaries are already fading out in the real world, especially since Wall Street introduced crypto exchange-traded funds, or ETFs. These funds trade exactly like stocks, wrapping digital assets into traditional financial products, which totally blurs the line between a commodity and a security.
Part 5. Market impact and future.
Let's zoom out and look at what this all means for everyday investors. If regulated properly, experts agree the Clarity Act could unlock just a massive wave of institutional liquidity. ETFs allow everyday people to invest safely, and pension funds are already starting to add crypto to their portfolios. Clear rules give these giants the green light to inject immense capital into the market safely.
But let's circle back to stablecoins. A stablecoin is a digital asset pegged to a traditional currency, like the US dollar, to keep its value stable. Because they act so much like cash, traditional banks are highly anxious. If crypto platforms offer these dollar-pegged assets with competitive returns, they could drain huge deposits right out of the traditional banking system.
Amidst all this hype, financial expert Fadi El-Kurdi offers a really stark warning. He notes that until this law passes, the market is driven entirely by supply, demand, and a dangerous case of FOMO, fear of missing out. He compares recent crypto swings, where prices plummeted from highs of $125,000 down to $60,000, to sudden crashes during the gold rush. His message: investors absolutely must manage their capital risk, rather than blindly following rumors.
So what's the takeaway here? In the short term, that voting delay until mid-September guarantees continued price volatility. The market hates uncertainty. But the long-term outlook heavily depends on whether this regulatory green light actually turns on, which could literally transform crypto from a speculative fringe market into a cornerstone of institutional finance.
Which leaves us with one massive question as that September vote approaches. Will the Clarity Act successfully stabilize this $3 trillion market and protect you, the investor? Or, by giving it the government stamp of approval, are we just taming the Wild West to invite even bigger financial players to the gamble? It is a fascinating situation, and the outcome will ripple across the entire global economy. Thanks so much for joining me on this explainer, and keep your eyes peeled on the Senate floor.